Welcome back to The Explainer. Today, we're going to fundamentally change how you read the market. We're zeroing in on the one metric that almost everybody ignores: open interest. Seriously, if you've ever felt like market prices are just flat out lying to you, well, you're not alone, and this is the exact missing piece of the puzzle. Today is all about the total bet counter.
Here is our masterclass syllabus for today. We've got the forgotten metric, market diagnostics, warning signs, and finally, trade execution.
All right, part one, the forgotten metric.
Look, most traders, they scan the weekly COT report just to see if hedge funds are net long or short, right? But they completely miss the top-line number that validates the whole thing, open interest. So what actually is it? By definition, it's the total number of outstanding futures contracts that haven't been closed, delivered, or expired. Now, unlike volume, which just counts daily trades, kind of like people walking in and out of a building, open interest is the market's float. It calculates the total number of people currently stuck inside the elevator. If a new buyer and a new seller enter, boom, a fresh contract is born, and open interest goes up. If existing traders close out, it goes down. It only rises when totally new money enters the game.
Let's break down how these three dimensions actually interact, because you really need all of them to be a good analyst. Think of the market like a river. Price? That's just your current equilibrium, the water level. Volume is today's activity, the flow rate. But open interest? That's the total capital committed. It's the total volume of water in the entire river system. To truly gauge market health, you absolutely need all three. I mean, think about it. A high water level with a falling total volume of water? That river is about to run dry. And this is exactly why looking at price alone will completely mislead you. Think of price as a rocket's altitude and open interest as its fuel tank. A rocket that's climbing while its fuel tank is filling up, great, it can keep going. But a rocket climbing while its fuel tank is emptying out, that thing is running on fumes and it's inevitably going to fall. Price shows you where the rocket is, sure, but open interest actually tells you if it has the fuel to stay up there.
Okay, moving on to Section 2, Market Diagnostics.
Open interest actually breathes in 4 distinct phases. It all starts with accumulation, that quiet phase where smart money sneaks in at multi-year lows. Next up is expansion. That's when the trend gets super clear. Conviction builds, and the new money just pours in. After that, we hit distribution. This is where smart money quietly heads for the exits, selling off to latecomers. And finally, contraction, the great purge, where all those latecomers get violently washed out. Knowing exactly which phase you're in, that completely changes how you manage your portfolio risk.
So by combining weekly price action with open interest direction, we get this really powerful diagnostic quadrant matrix. This matrix instantly reveals whether a market move is actually sustainable. Every single week, open interest either goes up or down, and price either goes up or down. Tracking these combinations is how you stay on the right side of those big institutional capital flows. Let's look at the absolute best-case scenario. When price is up and open interest is up, we're sitting right in quadrant 1. This is strong bullish, and it's hands down the healthiest state for a bull market. Why? Because that rising price is being heavily supported by brand new money actively expanding the participation. The trend has real, tangible fuel.
But flip the script. If the price is rising but open interest is actually falling, well, now you've hit quadrant 2, the weak bullish phase. This is an incredibly fragile rally. I mean, why is the price going up if money is actually leaving the market? It's because the rally is driven entirely by existing shorts buying back just to exit their positions, not by fresh money coming in. As soon as that short covering exhausts itself, that rally is going to fail hard.
Section 3, Warning Signs. Probably the most powerful warning sign you'll ever see is the open interest divergence. If you spot a sustained bearish divergence over, say, 3 to 5 weeks, where price is making new higher highs, but open interest is making lower highs and totally failing to confirm, that is an elite-level warning. It is screaming at you that smart money is quietly distributing their positions. The price might be climbing on the surface, but underneath, the market is actually shrinking.
Another massive warning sign to keep on your radar is the coverage ratio. When you're analyzing delivery risks, especially in physical commodities, you have to pay close attention to this. It measures exactly how many paper ounces exist for every real physical deliverable ounce. An extreme mismatch, like anything greater than 10 paper ounces for every 1 physical ounce in registered inventory, signals a massive potential squeeze. The market becomes super financialized and incredibly vulnerable. Spotting this mismatch early is exactly how you protect yourself from getting caught in a sudden liquidity trap.
Now this brings us to a really fascinating dilemma. You are inevitably going to face a scenario where the COT report is absolutely screaming overbought, but open interest just keeps on rising. Kind of feels like a massive contradiction, right? Well, this specific warning sign is called the standoff signal.
In a standoff signal, the COT data is hitting an extreme, but new money just refuses to quit. It keeps pouring in and expanding the market. So the absolute golden rule here is never fade the trend while open interest is still rising. Historically speaking, open interest wins the short-term battle because all that new capital keeps pushing the trend further. You've got to wait for the capital flow to plateau, for open interest to finally stall out before you even think about executing a reversion trade. The COT extreme always plays out eventually, but only when the fuel actually runs out.
And finally, Section 4, Trade Execution. Let's make this actionable.
Remember, open interest will always revert to its mean. It can't rise to infinity, and it sure can't fall to zero. So here is your diagnostic checklist for executing the open interest reversion trade. First, you need an extreme in open interest. We're talking above the 90th percentile or below the 10th. Second, you look for an inflection point, meaning that growth has definitively stalled. Third, you need COT confirmation of that extreme. Fourth, a clear price trendline break. And lastly, volume confirmation. This system works because it exploits a simple truth. An overcapitalized or undercapitalized market will always eventually snap back to reality. Let's see how this looks in the real world.
But hold on. You don't trade the exact same way in every single environment. We have to adjust our risk dynamically based on the market's breadth. So we take full 1.0x position sizes during Phase 1 accumulation because the market is completely washed out and the risk-to-reward ratio is prime. But when we hit Phase 3 distribution, we drastically reduce our long positions down to 0.5x. The fuel is running out and the market is getting incredibly dangerous. Let's run the historic 2024 gold surge right through our execution checklist to see this in action. After a long, really painful contraction phase throughout 2022, where open interest just kept grinding lower, we finally saw an inflection point. The growth stalled and then reversed. Next, the COT data confirmed accumulation was happening. Then, boom, the price trend line broke upward, backed by solid volume confirmation. And finally, new money just flooded the system, driving total bets past 550,000 contracts and rocketing the price from $2,000 to well over $2,400. Our checklist perfectly caught that massive reversal. To wrap up this explainer, I want you to remember one thing. Price shows you the surface, but open interest reveals the true life force sustaining the trend. It literally is the market's breath. So the next time you're getting ready to risk capital on a trade, ask yourself the million-dollar question. Is your market currently inhaling, or is it just about to exhale?